Drino, Global Markets Reporter at Nasdaq. Joining me at MarketSite, we have John Frank. He's a QQQ strategist over at Invesco, and we're here to discuss how R&D pays off for companies in the long term. So great to see you as always, John. And this is one of my favorite topics, how looking at R&D really is a measurement for a company's commitment to innovation.
Yeah, it is. I mean, we look at the companies within the Nasdaq 100 and QQQ as innovation companies, and it's really hard to measure innovation, right? And it's hard to see. I mean, you see it in the stock prices, you see it in the great earnings reports, but what innovation really means and where does it come from? I think one of the main factors is research and development, R&D spending. And interestingly enough, when you do spend R&D, it's actually a cost or an expense in a given year. So in a year that the expense is made, it could actually bring your earnings down. And it's a way for companies to, I don't want to say cheat, but a company that if they're close to hitting their earnings target and maybe you spend a little less on R&D or cut expenses in other areas, they can hit their numbers. So a short-term view, that could be good for the stock, but the companies within the Nasdaq 100 really have a long-term view and are investing in R&D, and we've seen that over a period of years.
Right, and sometimes you have to spend money to make money, and that's not always going to happen with share buybacks. That'll only get you so far in your stock price, but we saw it over the earnings season in the tech and information space, which is really Nasdaq 100 heavy, and we're seeing it translate into earnings.
Exactly. Yeah, I mean, you're seeing this has been years of innovation and research and development. You actually look at the index, the Nasdaq 100. We look at how much they're spending on R&D. It's on an average weighted basis close to $10 billion a year. When you think about the S&P 500, that's closer to $3 billion. So right away you say, oh, that's a lot bigger R&D spends, but you have bigger companies than the Nasdaq 100. So it's maybe not fair to look at how big the budgets are, but then you actually compare the R&D budget to the sales figures and revenue. What percent of revenue is being plowed back into the company? And you're seeing that almost double, 10% of revenue within Nasdaq 100 companies going back into R&D. And you've seen it really play out with Invesco QQQ's performance over the shorter and longer term.
We certainly have. It has been quite a year for that. Now, speaking of valuation, we do have to discuss this. What's your thoughts on market valuation right now? There's a lot of things out there trading triple time PE, and that could be a concern.
Yeah, valuations are always an interesting topic. And one thing we've looked at when you look at the Nasdaq 100 forward PE ratio, right now at the end of March, it was about 21 times forward earnings. And you compare that to the S&P 500 index, it's about 17 times earnings. I think a lot of people look at that 21 and 17 and say, wow, the Nasdaq 100 is expensive, or QQQ is expensive. But when we actually looked at what the companies in QQQ are growing faster, so you should pay a higher multiple. We looked at what's the average PE since 2004, let's say. And for the Nasdaq 100, that average PE on a forward basis has been about 20 times. So today's premium of 21 versus 20 is about a 5% increase.
Right.
When you do that same analysis for the S&P 500, they're actually trading 10% more than their historic average. So on a relative basis, you could argue that the Nasdaq 100 is actually cheaper because you'd expect these companies to trade a little bit higher, but how much higher versus their average? The Nasdaq 100 isn't quite as high.
Right, and we're seeing that for first quarter earnings right now. People are paying up for growth. They are looking anywhere to get some growth, so that is encouraging.
Exactly, yeah. They're seeing, you see that last night. Microsoft reported, and Azure, their cloud business was growing 75% year over year. So sometimes people think of a company like Microsoft and it's an old tech company. Well, they're one of the leaders in the cloud space.
And they've spent money in R&D.
Oh, yeah.
This took a while to turn around.
This doesn't happen overnight. This is years and years of spending and really perfecting it, and they're still spending on it to make sure it's even better in the space going forward because it's going to be so competitive.
That's why they have $1 trillion market cap right now. So congratulations, Microsoft. Thank you so much, John.
Thank you.
As always, for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.